Good afternoon, Mr. Cheatham.
Good afternoon, Sherry. How are you?
Doing good. How are you?
Good afternoon, everyone. Welcome to the special call meeting of the CERS Investment Committee. We have a couple of items to consider this afternoon, and we'll get started very soon. Could we start with the opening statement? Eric, would you do that, please?
Yeah, this is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you're speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sherry, would you take the roll call, please?
Yes, sir. Dr. Hackbart,
Here.
Mr. Cheatham,
Here.
Mr. O'Mara,
Here.
and Mr. McGraw.
Here.
Thank you.
Thank you, Sherry. I don't believe we have any public comment, do we?
That is correct. No public comment today.
Okay, good. So we can move right to our agenda item. Basically, this afternoon, we have two issues to consider. They are extensions. One is with HIG Capital, and the other is with Adams Street. And we would like to have a good discussion of these issues and so forth. So Steve and Anthony, could you give us a brief background on these two issues? I know the information has been distributed. Kind of a brief background on both of these, maybe handle them separately. I think probably they would be action items separately. So if you start out with HIG, we'll handle that one, and then we'll have a separate presentation, discussion, and vote on Adams Street as well. So if you would proceed, thank you.
All right, thank you, Dr. Hackbart. Want to thank everyone for their time today to allow us to present both of these recommendations. And as always, thank Sherry and Sandy for all the work they do to coordinate the meetings. I know we ask a lot of them. Brian Caldwell and Anthony Chu are not available. They had prior commitments, and these are their respective asset classes. So I will do my best to cover them. And I know Wilshire's on the call as well and has been consulted on both of these amendment requests. So for HIG, one page forward, please, Sherry. HIG Capital is proposing an amendment to the LPA to extend the term of the HIG Capital Partners 5 fund by one additional year until July 1st, 2026. And this is a 2013 vintage fund whose original final term was July 1st of 2021. CRS original total commitment across pension and insurance was 18.1 million. And the value of the CRS investment in the fund was marked at 7.2 million as of December 31st, which represents approximately 4 basis points of exposure of CRS's total assets. So not a significant size. The original final term was extended 2 years at the discretion of the GP and has subsequently been extended 2 more times for an additional year each time by the approval of the majority of LPs as required by the LPA. The first 1-year extension that was approved by the LPs included a reduction in management fees from 2% to 1%. To date, the fund has performed very well with a net IRR above 22 and a DPI of 2x, with the majority of investments in the portfolio realized. You can turn forward, please, Sherry.
Steve, could
Yes.
you find, for the committee, when you say 2x, define that for us, please.
So DPI is a measure that's used. Again, we know the difficulties with the performance calculations for private markets, and DPI is specifically distributed to paid in. So that's how much you've gotten back relative to what you put in. So essentially, it's a doubling of your money, right? A DPI of 2% or above. So that's with the majority of investments realized already.
And that's over a 12-year period of time.
Yeah, so this was a 2013 vintage. We're at 2025, so yes, we've had it invested in it for quite a period of time. And again, that A net IRR for a mature fund, has more relevance than, as we'll see here, in the next presentation. In an IRR for shorter periods of time tends to be a little bit less relevant, but that's above 22%. It's been a very good performing fund for the portfolio.
So
and while we,
I got,
sorry, yes, absolutely.
I'm sorry. I was going to say, I got a question. So nowhere on this sheet, I don't see anywhere it says net gain or percentage gain or percentage loss anywhere. That doesn't show. Am I missing?
If we look to Wilshire's memo, Sherry, page 3, pages forward, I believe. One,
I'm sorry. I was
2.
just ahead of
That's
you.
all
I
right.
apologize.
No worries. You can see that Wilshire here has as of September. So we know all private markets have delayed reporting. The most recent reporting that we have is December. I believe Wilshire used the September 30th marks for the fund here, and you can see that it had a DPI of 2.0, so 2x, and a net IRR of 22.4% as of marks for September 30th, 2024.
That 22.4 though is over the life, is that correct?
That's correct.
So
That's since
again,
inception.
over a 12-year period of time.
Over a 12, yes, since the initial investment, correct.
Okay.
So it's performed well. No issues with performance of the fund. As Anthony will say, this is certainly this strategy for HIG is been one of their better performing strategies. We have a different HIG fund that has not performed nearly as well. It's a capital constrained fund, so as you may have noticed, the original size of the fund was $1 billion. KPPA commitment was only $20 million. That's the max that we were able to commit back, 10 years ago, 10, 12 years ago. So it's capital constrained, which means there's a limit on how much each LP was permitted to commit to the fund. And that's partially because of the strategy itself and its limit on size.
Steve, I realize, these asset classes aren't ones you're over, but do you have any idea, since they've started extending this thing, 3 years ago, 4 years ago, are we still, for the rest of the committee, that this fund owns, I think we were told, Dr. Hackbert, somewhere around 8 different companies still left in the portfolio. Does that sound right?
Yeah, I think that's right.
Yeah, I think that's the majority. The majority of the investments, remaining investments, are in 8 investments for the portfolio. Correct.
My question is, if we're winding these down over the last 3 or 4 years, do we have any idea, 3 or 4 years ago, how many companies are we actually winding them down, or are we kind of dragging it on?
I can get you the specifics. I don't have that offhand, but there have been realizations over the extension periods. And it's kind of a mixed. They have, if looking at the portfolio, the existing portfolio, the remaining portfolio, it's there's still several strong investments in there that have performed very well. Looking at kind of on a gross MOIC basis, they're marked high. Again, marks are marks, as we know. Realizations are what we can eat. But there are several what I would consider very good investments remaining in the portfolio. But we have been receiving realizations over the past 4 years since the extensions occurred. It's been slow. And that's consistent, as we know, we talked about many times, with especially in the private equity markets and the lack of realizations across the market. They've not been immune to that either. The pace of realizations has been slower, probably than what they had hoped for, what they anticipated. Whether or not that changes over the next year, I think that's to be seen. The expectation is they're continuously working on, economically beneficial realizations to the remaining companies in the portfolio.
Okay. Sorry to interrupt with those questions.
No, those are good questions, and happy to get you back on kind of, we can do snapshot point in times as to what, cumulatively what the realizations are. We do report that to the investment committee on a quarterly basis. I know it's buried deep in some of that capital calls and distributions report, but the amount of realizations that we see quarterly for each of these investments, both capital called as well as distributions, is reported. But we can certainly summarize that for you guys. But I would say that we have been receiving realizations, so it hasn't been at a standstill, a complete standstill. They have been liquidating companies as opportunities exist. So, while Wilshire's memo here, Wilshire took a look, and I think they were supportive of it. While we agree with Wilshire's comments regarding the benefits of orderly realizations potentially being a benefit to performance, as we've previously discussed, for funds post-investment period extension requests that require LP approval, our position as a staff is that there should be some consideration for that extension. As we saw two extension requests ago, the reduction in management fees, something that's in line with, kind of granting them some additional runway in order to have realizations in the portfolio. So we expect some consideration, or we would hope for consideration for managers. In this case specifically, the management fees will remain the same or unchanged over the period of the extension. Historically, as we talked about earlier as well, that some managers also offer consideration through favorable access to current or future capital constrained funds. That's not the case for us. We're not looking for investing in future funds, so that wouldn't be something that they are necessarily offering here, or something that we would be interested in. So accordingly, our recommendation is not to approve the requested extension. In full transparency, we're a very small part of this fund, right? It's less than roughly 2% of the overall fund investment is KPPA's investment, so CERS is slightly less than that. This is likely to pass, so the fund's likely to extend a year regardless of what action we take here. But our recommendation is, given that there was an additional consideration given for especially on the management fee concession side, to not approve the extension request. I know Wilshire provided a memo here. I'm sure they can provide comments as well. I know David's on.
So Steve, just to put in context, in effect, your recommendation is not to approve, but in reality, whether we approve or not is not terribly significant, because it would probably be continued anyway. Is that correct?
That's correct. I mean, again, realizing that we are a very small part of this fund, it's likely that they will get approval to extend the final term an additional year, regardless of whether we vote, or if we vote, or how we vote.
Okay.
But our recommendation to you as fiduciaries is that we don't think it's appropriate to grant this. Before Wilshire might step in, Sherry, if you go to page 4, 5, and 6 and start on 4. This is also something that we discussed. We talked to Dr. Hackbart and to Mr. Cheatham and to Ed as well. We've got two views here of the private equity, the CERS private equity portfolio. And on page 4, we see this is more detailed information on the current portfolio, focusing specifically on the original terms of the investments as well as their current status. And as you can see, CRS has a significant number of legacy private equity investments that are more than 15 years old, well beyond what was their original term. And that's although they do represent less than 60 basis points of CRS overall assets. So there's a significant number of line items. They're not large in size, and they don't represent significant exposure. But you can see here that's a lot of very old legacy investments. The status winding up, extended. It's kind of a hodgepodge. What you'll see on for the most cases, when they end that after the final term, however many times it's been extended, and you'll see one extended 13 years, right? We talked about that final maturity, and unlike in the bond world, maturity doesn't really mean the same thing. We see lots of terms thrown around: wind down, liquidation, harvest, or realization, when they've reached ultimately the contractual end of term. And that end of term, whether it's original or extended, many of these investments will go into this mode where essentially they're looking for opportunity to sell, and that can persist for multiple years, right? So we have investments that are you know, 20 years old, that are still in wind-up status. The next page, Sherry, on page 5, and it's just so these are the really old ones. The next page, the next 2 pages is the totality of the private equity portfolio. Again, we're really focusing here at the request onto final terms, original final terms and current status, whether that's extended, in liquidation or wind down. I would note here, especially on page 5, we see a number of funds that are fast approaching, probably within the next year. Their current final term doesn't necessarily mean it's their final extended final term. So we're likely to see more of these. There is discretion at the GP level, and we see on a number of these where a manager may elect not to extend the fund, may enter into wind down, may extend the term at their discretion. Typically, these documents, and Wilshire can comment as well more broadly, but you see some have optionality for the GP at its sole discretion to extend once, twice for a period of years. Typically, then the additional extensions require LP approval. Usually, it's majority of LP approval. And that's limited to in the original LPAs, you know, whether it's 1, 2, 3, or how many years of extension they can request. So we're likely to see more of these, kind of just based on where we see existing current final term, stated final term for a number of our investments. So over the next year, we're likely to see, and again, that's partially based on market conditions as well. As we know, exits have been difficult. So, you know, getting that obviously we support our managers in, you know, being prudent, and not fire sale, not liquidating portfolios, but you know, being prudent and seeking the best possible return for the systems.
Well, thank you, Steve. Are there any more questions? If not, I would accept a motion to approve the staff's recommendation.
Just one note, and then I'll be happy to make a motion. Steve, the page 5 doesn't give us a total of what the current values of all those are. If you don't mind sometime to get us that.
Absolutely, we can do that. Yeah, the total across, so on the percentage basis, we know, you know, across all of the portfolios, again, this is aggregated, but across all the portfolios are around 5.5% to 6% in private equity. So below target. Typically, we've been structurally below in our private equity portfolio. Wilshire's on as well, and I don't know if you guys want to ask them. Obviously, we appreciate that they provided some, you know, they provided comments on both of these recommendations. You know, if you have any questions for them as well, if they want to provide any comment here, that would be great.
Yeah, and I've got another question. I'm sorry.
Sure.
Y'all just bear with me till I figure out how to tread water here. But so you said as far as selling goes, so this is pretty much going to sell like a mutual fund.
So
Right.
these funds owned portfolio companies, so they own an equity investment, private equity investments into these companies. So they own some part of a company or the totality of a company, depending on the structure. And they're looking to sell those, right? To sell those either to another fund, is typically, or to another entity. And what we've seen, especially in the private equity market, is that's called, you know, the realization. So they make the investment, they make changes to the companies, they help improve, they grow the business, whatever it might be, that where they add their value. They buy it for $1 million, they want to sell it for $2 million. That realization part across the industry has slowed down considerably, partially due to economic conditions, partially due to you know, financing conditions. So the distributions back to us, the ultimate investor, have slowed down significantly. And that's, you know, again, our investments are not immune to that, whether they're current or whether they're legacy. You know, finding that buyer for that portfolio company has taken more time than certainly people anticipated. If we look at pacing plans or you know, what the original terms of these investments were, it's taken longer for them to find the ultimate buyer at the right price.
Gotcha.
for a number of these companies.
All right. So, and with that, let me follow that up with, so is there, with the economic fears right now and the market downturn here of recent and going back up now, but so is there something like a minimum threshold, like a limit sale, like in a regular market? I tried to do some research, so I wouldn't ask you a bunch of questions that were.
Oh no, I appreciate it, we're always happy to have the discussion. So there's no,
That's, I know I can sell my stock at a limit. I can set a limit and let it sell. If it comes back down to that, it's going to sell for me, and I ain't got to worry about it. But
so
Tom-
it is. Yeah,
Tommy, going back
it's
to the original
sorry.
question about equating it to a mutual fund, the best answer I can give you is like owning a mutual fund without the liquidity.
Gotcha.
We're kind of stuck on the ride every how long they want to drag it out.
Gotcha.
That's what we're dealing with here.
Well, of course,
Hmm.
the market that I'm accustomed to looking at, it's set up completely different than what this is, which of course it's comparing, peanuts to apples. But, just to try to educate myself a little bit, I tried to do some research and I found 10 different things, and I was like, well, which direction is this? So then I thought, well, I'll just wait and ask. But
Mhm.
that was my concern, and I get out of it. But that was my question. Is there like a limit, or are we going to be? Is there a minimum, or if it's, we know supply and demand is the key to everything in the market, company valuation and everything else. So essentially, there is no limit,
Yeah,
There's
we're
no.
top limit.
kind of stuck. That's the drawback of being the limited partner, I guess.
Gotcha.
But my concern, and that's why Dr. Hackberg and I asked for some of this information you're seeing on slides 4 and 5. Some of these things, go back to 2000. They've liquidated themselves down to next to nothing, but it's still our money that's sitting there.
Correct.
And if I understand Steve's recommendation, is much about sending a message to in this case HIG, that hey, we're tired of this thing dragging on out,
Gotcha.
particularly without giving a reduction in the fees, because the general partner sits there and makes, I think they reduced it down to 1%. Is that right, Steve?
Correct.
Back when it was a fresh investment, they were charging 2%, but now we're down to $7 million in this thing. So at 1%, that's what, $700,000 in fees, or no,
70.
$70,000 in fees, excuse me.
No, you're fine.
So yeah, I'm calculator dependent.
Gotcha.
Anyway,
But okay,
one thing
that's my whole thing. I was
from
just wondering, and like I said, I know this is a quick meeting and it needs to be quick, and I apologize, but there were just a couple of things that I was trying to get my head wrapped around, and that was one of them.
oh,
No, and I think that's a great question and a good, education for everybody on the understanding. And that's, it's one of the things that we consider when we invest in private markets. And, Wilshire can comment, there's always hopes and expectations that we may have some exchange at some point for some of this. And there's, whether anything, I'll be a seller of that rumor, but, this is a meeting of the minds market, right? There's no exchange, there's no listings. This is, you have to source on the investment side. When you're making the investments, you have to source those opportunities. And then when you're selling them, you have to source the appropriate buyers. Now, as we've seen, especially, with some high profile endowments, we've seen recently some of them taking a book, part of their portfolio to essentially market it as a secondary sale. And that what you get back on the secondary sale pricing at this point in time, it's certainly going to partially be dependent on the quality of the asset, but there's also an embedded haircut in there that whether you're willing to take that. You can find liquidity at a price in these markets, whether if needed, but you certainly don't want to be a forced seller. And that's the idea, is it's part of the timing is finding the right buyer at the right price.
Well,
Got
the key thing is that when you use the term private equity, that's exactly what it is. It's a private transactions, not in
Correct.
public market.
Yeah. Got you.
And Mark,
Well,
maybe
thank
you
you.
want to give a few comments from our perspective.
Sure, and I don't think our perspective is all that different than Stephen and staff's perspective. We came up with a different recommendation on this one, but we don't disagree with really a lot of what they said. Typically, at this stage of a fund, we expect them to extend. 12 years into the fund is common. This will probably go on for at least a year, if not more. Usually after the second set of extensions, they start discounting fees even more. In this fund, we took that into consideration, that they reduced it from 2 to 1. We also look at existing performance. So if you look at those 20 or 25 funds, you're going to get a request from all of those over the next year or two to extend. And some you're going to recommend don't extend. I think the philosophy of, hey, whether you extend, don't approve, wind up, and that it's kind of the nomenclature is the same, you're going by the assumption that GP is going to function the same way regardless of your vote, meaning they're going to try to maximize value. We've seen in the past that that's not always the case. Sometimes if you say, hey, we're not going to extend, that GP could call your bluff and say, okay, we're going to liquidate at any cost. Now they're not aligned to do that, and most GPs that have a solid business like HIG does, they're going to do the right thing by the client anyway. So by not extending here, they're still going to extend. But the consideration here, this fund, it's one of the best performing series of private equity funds that exists. We're investors going back to Fund 1. We're in Fund 5 as well. We have the same recommendation going to our internal investment committee, where we did this on the discretionary side. So we look at how have they done, what's the likelihood of them being able to add more value to this portfolio going forward. HIG is known for doing that. They typically hold their marks below where they end up transacting at. And we do see a lot of end of life value beyond what the fee that they're going to charge is. The other consideration is, are you going to be investing in private equity in the future? And if so, this is a very hard to access manager that, when you don't extend that request, are they going to treat you differently if you do want to get into that investment? They're launching this fund, the next iteration of it kind of in probably, the next 6 to 8 months. So, if it is a fund that you want to commit to, behaving as a partner in terms of, hey, they've gotten good performance, they've lowered their fees. We also know that this is going to pass. So what Steve said is, regardless of whether we vote a yes or a no on this, it's really more of sending a message. We think, given where performance was, given that they did reduce fees last time, we're leaning towards approving. But as Steve mentioned on this one, whether you do or not, it's likely going to be the same outcome, and it's going to extend.
As I understand, I noticed, Steve, on your all's recommendation sheet, you've got abstain/do not approve. Aren't those two separate options? You can either approve, not approve, or abstain.
Abstaining is just like not approving, and a lot of people will, and it's probably often even better of an approach of just not responding. You're going to get treated better in the future if you do decide to invest in HIG in that case. But
Effectively, it's the same. Yeah, effectively the same. But I would completely agree with that comment. Yes.
Okay.
So would the motion be to accept
Abstain. I would say, I think that's probably,
recommendation of abstaining? Okay.
That's where I was getting at. If that's the case, I'll certainly make the motion that we abstain from, disapproval.
Yeah. As you go forward, when you get these recommendations and you don't provide any vote, if they're short of getting that vote, they will then come back to you and say, hey, we're pretty close. You're that extra 2% that we need. What do you need to do it? And then you can say, hey, I want a 50% reduction in fees or a 25%, and then you have a little bit more kind of juice to pull with. And that's why often I'm stating you get kind of the best of both worlds there.
So we have a motion to abstain and not approve a continuation. Is there a second to that motion?
I second it.
Motion's been made second. Any further discussion? Not, we can proceed to vote. All in favor of the motion to abstain and not to approve the recommendation for continuation, please indicate by saying aye.
Aye.
Opposed? Motion carries. Steve, would you present the recommendation regarding Adams Street, which I believe is a recommendation to support the continuation. Is that correct?
That's correct. Yes, one more page, please, Sherry. Thank you. And you also see Wilshire, appreciate that they provided a comment and memo on this one as well. As you may know, Adams Street Partners is requesting an amendment to the LPA for the Adams Street Private Credit Fund 3 to extend the final admission date to March 31st, 2026 from May 31st, 2025. This is a 2023 vintage fund that has a target size of 2.7 billion, of which approximately 1.7 billion has been raised to date. In 2023, CRS committed to up to 175 million in Fund 3 with an additional 175 million, up to an additional 175 million to a co-invest sidecar vehicle. And these commitments were a re-up. So essentially it was rolling CRS's existing exposure in the Adams Street Private Credit Fund 2, which was maturing into this new Fund 3. CRS investment in Fund 3 totaled 88.7 million, approximately 47 basis points of CRS total assets of exposure as of December 31st. The fund's early performance has been very strong. As I mentioned just a couple minutes ago, IRRs at this stage are not necessarily the most meaningful kind of in the early stages of funds, but the funds posted a net IRR of above 30% and a MOIC. So the MOIC is the multiple on invested capital of 1.1 at this early stage. So they've had realizations. That's good. Fund 3's original term was 6 years, subject up to 2 one-year extensions. Those extensions require consent of the advisory committee. The basis for this recommendation is market conditions for private credit remain very favorable. The Adams Street team continues to deploy capital at very attractive terms. The amendment permits the fund to accept new investors for a longer period of time, allowing Adams Street to grow the size of the fund. Growing the size of the fund is a benefit to the existing investors through a larger, more diverse investment portfolio and by fixed cost across a larger capital base, which reduces the cost burden for each dollar of investor commitment to the fund. The increased fund size, we also believe, would allow the fund to be more competitive in more investment opportunities with a larger share of financing opportunities. So our recommendation, which is consistent with Wilshire's recommendation, is to approve. I would note that Wilshire did make a very appropriate comment regarding anytime you have multiple closings for a fund, the marks for that fund for the existing investors, and how that's adjusted for by the manager or the fund specific to that new capital being committed. Obviously, especially in cases where assets are marked up here. They did identify that as not necessarily an issue, but wanted to highlight it. That's consistent with that's not new to this extension. That's part of the current LPA and how that has been handled for multiple closings. So we are comfortable with that. Happy to take any questions on this one specifically. So again, that the prior was private equity. This is in our specialty credit, private credit, and it's they invest primarily in first lien senior secured debt.
Any questions, Steve or Wilshire? Wilshire, do you have any additional comments that you'd like to offer?
No, I think Steve mentioned kind of what we wanted to know.
Okay.
with that, and it's written in the memo there, so no addition.
I'll make the motion, we accept staff's recommendation to approve the extension of fundraising time. I don't see where that impacts the investment whatsoever.
Thank you for the motion. Is there a second to the motion, please?
Second.
Motion is made and second. Thank you. All in favor? First of all, any further discussion? Hearing none, proceed to vote. All in favor of the motion to accept the recommendation of staff to support the continuation, please indicate by saying aye.
Aye.
Opposed? Motion carries.
Thank you. And I also wanted to note, I appreciate Wilshire turning this around. So on a very short basis, we didn't give much time to provide their comments. So I appreciate you guys turning that around so quickly to us.
Happy to do so, Steve.
Promise to give you more time in the future. It's always my goal.
We know.
Dr. Hackert, you're on mute.
Sorry about that. That concludes the agenda for this afternoon's meeting. Thank you all for being here. And I think it's been a very good and clear meeting and discussed these issues. And so with that, we'll declare the meeting adjourned.